Steph, let's go to the investment side of things. I know this will be interesting to many. So maybe give us a rundown of eligible investments for an FHSA, and then maybe just talk to us about strategies. Like one thing I like to think about is because if you open an account, from the day you open it, there's essentially a 15-year window. So for me, that time frame is similar to when we open up an RESP for our kids and our kids go to school. So I'm wondering if a similar strategy to how we invest money in our RESP could apply to the FHSA. Whether or not you agree with that, I'd love to hear your take on this. Just give us a little rundown here.
Sure. Yeah, those are great questions. So first of all, there's three basic types of first home savings accounts. So they're starting to roll out now. Some of them are available as of April 1st. So the three different types are, the first one is a depository FHSA. So that's an account you'd open up with a bank, for example. They're going to hold your money in that account for you. You could buy a GIC or some sort of term deposit, and that'll be what you're doing with your money there. Secondly, there's a trusteed FHSA. So that's a trust that you are entrusting to a company who acts as the trustee and holds that account for you. And this is the one we're more familiar with. So if you're a self-directed investor and you have your own RRSP or TFSA, you can have a self-directed first home savings account as well. What can you hold in there? It's basically the same as a TFSA. So you could keep it in cash. You could buy GICs, bonds, stocks, mutual funds, ETFs, securities that are traded publicly on stock exchanges. Those are all eligible for a first home savings account. The third type is an insured FHSA. So that would be provided by a licensed annuity provider under an annuity contract. I haven't seen any of those yet, but that's one of the three categories the CRA is allowing to open up and house FHSAs. I'll also mention here, like with any investment account, be aware of fees and ask questions. So people should, if they're opening up something at a bank, ask those questions. Like, when I do this, are there any asset under management fees because you're helping me with my whole portfolio? Are there any management expense ratios with the product I'm buying? There could be administrative fees, transactional fees. So it's always good to ask those questions. I know a lot of your folks listening are probably self-directed investors. A self-directed account should have pretty minimal fees overall, especially if you're a knowledgeable self-directed investor. So just be aware of that. Yeah, good question, Yathin, about timelines and investing and what might you do with that money. I like your analogy to the RESP. Of course, for some people, they're putting this money away to buy a house, right? So that might be a very short timeline. It could be 2, 3, 4 years, that sort of thing. But in general, and this can apply to really any type of investment account, we usually break down investment timelines into short, medium, and long term. The time component of each one might be different for different reasons for folks. But in general, if you need money within about 5 years, be conservative. Protect your principal. Don't get too fancy. Don't put it into equities because you're exposing yourself to market volatility. So things like GICs, high interest savings account, money market funds, cash ETFs, those are smart, fairly safe, conservative products. If you're looking at sort of a 6 to 10 year window, well, that's a medium timeline. You could probably take on a little more risk with that. Maybe for somebody that might mean a 60-40 ETF, 60% equities, 40% fixed income. If you're planning longer term, and I call that 10 or more years, you can probably take on more risk with that. As long as it's appropriate and tolerable for you as an investor. That might be 80-20 for someone. It could be 100% equities. I think a lot of this too ties in with your flexibility with regards to your timeline. If you have a very rigid timeline, play it safe. If you're flexible, you could maybe take on a little more risk. And what I mean by that is, if you're focused on buying a house, if you take a little more risk and you put some more money into equity markets, are you willing to delay your house purchase? If something happens, markets drop 20, 30, 40%, are you okay putting your plans on pause? If you're not, well, don't do that. If you are, maybe you could take on a little more risk.
I think that's so practical. Thanks, Steph. Now, one thing I have not been able to figure out just through my own reading is, and this may not be a make or break for other people, But the concept of foreign dividend withholding taxes, we know that the RRSP is exempt from these withholding taxes, but does the same thing apply to the FHSA?
Uh, no, it doesn't. So you're correct in the RRSP, foreign withholding tax, because the U.S. looks at the RRSP as a retirement savings account. They don't apply that
Okay.
foreign withholding tax on dividends. It does apply. So foreign withholding tax will be deducted if your investments are exposed to that in your first home savings account. And that's the same rule that you would see with your tax-free savings account.
Yeah.
Another point I'll mention with that sort of train of thought, first home savings account are not afforded creditor protection. So under our
Oh,
Bankruptcy and
okay.
Insolvency Act, yeah. So if you go bankrupt
Okay.
and you have a first home savings account, that's fair game for creditors. Same with the TFSA, fair game. Your RRSP is protected if you were to declare bankruptcy, for example.